Good evening, ladies and gentlemen. Today is the 7th of July and a very interesting day. I managed to close down 1.5 points, mostly because of the last minute short covering and making a bad entry. But we yesterday, when there was profit booking in US futures, we saw Indian futures take quite a hit, but we opened more or less better than expectation. And after an initial dip, we saw aggressive buying and then aggressive selling. And even though the market more or less for majority of the day didn't really do anything, it was quite tricky to handle because there's an event coming up and whatnot. The opposing option was unwilling to give up value, so it was a constant day of call side IV spikes and put side IV spikes, and then reversal back and forth. And I think relatively among all the days I've traded so far, I think this will sound quite surprising to a lot of people, but in a while this has been relatively more tricky. I also think I've made some mistakes today. I'll have to go over my trade logs and come up with what I could have done differently, what was my thought process at that point of time, and look into that, because risk is being priced quite low. And while risk is being priced quite low, your room for error is very little, right? So all that being said and done, towards the end, I think it should have still been all right. We saw an amazing short covering that propelled the market higher, and at that point I just took the exit because it just didn't make sense to keep going. So anyway, this is an interesting setup, and tomorrow's expiry as well should be quite interesting. Let's see if the event has any effect or not. So thank you so much for watching this. I've commented on a lot of other things. Initially during the day I thought there would be more free time, so I gave a few pointers, things that I look at and whatnot. And yeah, have a great one. I will catch you tomorrow. Take care.
Want to meet like-minded traders and discuss option strategies, adjustments and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Good morning, ladies and gentlemen. Pre-market has just settled and looks like we're opening with a slight gap up. I don't think that will hold. I think as per what SGX is suggesting, there should be an immediate 20-point dip at least. And more or less the trade plan for today being a Wednesday, risk to burn is in my favor. The resistance that I will be working with is 15,900, because we have seen once, twice, thrice, 4 times, 5 times, 6 times, many times that range somehow just pulls in profit booking. And what happens, basically every time we're about to break, suddenly a lot of new longs also get built. Okay, now that finally range break on the upside is going to happen. And when it fails, right, a lot of this is because of the kind of longs that get built in to trade this breakout. So everyone is dead set on this breakout eventually happening, and every time we go here, more longs are added. And generally when fuel for one side is added, then in case it doesn't work out, it just changes color, becomes fuel for the other side, which is why we see this. Yesterday, US markets also quite a bit of profit booking, and now they are kind of flat. I continue to work with the idea that yesterday also spoken 15,800 has a high likelihood of being the expiry spot, and there is very good support from 15,700 on the downside. So more or less my plan will be to trade this range, the 15,700, 15,900 range, and I'll keep you posted. So at the entry though, I will wait. I generally say I will wait, and then I don't really wait too much, but I will wait about 15 minutes before taking entry into the position, see what happens, because between pre-market and what SGX is indicating, there's a good 20 plus point difference. Also, I closed the entire bank Nifty calendar spread part of the trade. Effectively on the trade, I booked about a loss of 90,000. I posted about it on Twitter, since yesterday I didn't really do intraday trading beyond 11 o'clock, and I closed the video early. Okay, I have just entered my position. Initially I tried to enter the 15,800 straddle, but realized that there will be too much of an issue dealing with call expansion, because right into the open we made a quick down move of 30 points to catch up with SGX, and then from there we had now up about 80 points, just like that in the first 15 minutes. So my position is fairly straightforward. I have a 150 point strangle. I'm expecting 15,800 to continue acting as a support, and act as a potential expiry spot. Expiry spot right now I would think would be 15,800 or 850, not too much higher than that. I'm still expecting 15,900 to act as a ceiling kind of a resistance. Right, so 15,900, quite a lot of resistance. 16,000 is the ceiling for this time, but 15,700 put as well. Quite a lot of open interest building since morning. Regardless, I potentially stand to gain about 10 to 15 points on a position like this. So I will be willing to take about an 8-point risk. Not a great start to start off with, 3-point negative, but fair enough. It's Wednesday, and there should be some amount of volatility, and we'll keep you posted. The time is 9:34. As of now, the option chain is not showing too much data. It will take some time to build, but once again, a lot of straddle positions continue to add at 15,800 and some at 15,850 as well. I'm expecting whatever is happening here to eventually take resistance here or here, not go too much further than that. But of course, in the meantime, there can continue to be a lot of call side heavy spikes. Okay, something to note is IT and Reliance both look really weak, and with IT results coming up soon, TCS results coming soon, I have a cash secured put on TCS at 3,200. What I'll do to, in case it goes in the money, to protect myself slightly, I'm selling. TCS is just about 60 points out the money there. I'm going to sell this call, which still has good value because of the high IV at this point, for 41, in order to just take a little bit more credit. Now the call side IV is cooling off, puts are starting to expand. We're back at 15,800. So yeah, I mean, wild moves already. I'm gonna wait for 15,800 to break. Meanwhile, I will have to. What I will do at that point is roll away my puts to 15,700. 15,800 breaks, I'll roll away majority of my puts. We'll keep you posted. Okay, so to not deal with the put side IV expansion that will now take place, because after the dip got bought for about 80 points, we have now seen a steep 50-point down move, and this is Wednesday volatility. I got played initially on the upside volatility, but regardless, I've just taken some risk off on the put side by moving the 15,750 put to 15,700, giving me a lower risk reward spread. One good thing to the down move is that since there was a call side expansion previously, whatever fall off was there did benefit my position, and now premium wise quite balanced, should be able to protect against right moves here and there, unless there's once again a big short covering move, and then we take the day's high out very easily. So regardless though, I mean, if this same situation were to play out on any day except Wednesday, I would be doing much worse than being down 2 points. I would be down a lot more than 2 points from something like that. So we'll keep you posted. Time is 9:51. Also, one more thing, I have this cash secured put on TCS. Results are coming out tomorrow, and in order to take in a little bit additional credit, because TCS is now just 50 points away from my strike, I've also sold the 3,400 call. This I had got about 41 points for it, and that because the IV is high, I'm getting very good call premiums. Also, just before the results, IV will always be high. I sold this put option with the intention to take delivery of the shares, so I will be taking delivery of the shares in case this is in the money towards expiry. But at the same time, I don't want to now expose myself to some big down move, and to also better my price in case I'm in a position where I have to take delivery. I'm selling this call option, so my effective buying price of TCS will actually be 3,100 in case this put goes in the money and I have to, take the shares. Okay, I'll show you a trick, right? So right now we're making a down move to 15,800, which is maximum open interest, and also again easy to assume that it's a preferred expiry spot. Now into that down move, something like, let us say, the put options are expanding. Now you take a look at what is really causing this down move. Yes, it's IT. IT is falling non-stop, and now the next visible support is in this region, right? So you can say this region here to here. And you look at, so you can think that, okay, IT will take support somewhere there, but IT is unpredictable. You don't know what happens to IT just before expiry days and on expiry days. and plus results coming up and whatnot. Take a look at Reliance. Now Reliance 2100 is a big support zone, right? So 2100 on Reliance is a big support zone. You have a lot of people who a lot of demand for Reliance will start picking up at 2100. So that is one way of assuming, okay, we're making a consistent down move. Market is dipping, put options are increasing, and as I speak, that same IV spike, which we just saw right now is 18, 19, it will come down immediately. So generally when people who do scalping trades, right, people who do like quick in and out trades, what they try to do, especially if you're scalping on a contra side, is they'll wait for some kind of a setup like that, where, for example, there is a quick down move to what you're thinking will act as a support zone. You're seeing that whatever is causing the down move also has supply zones, demand zones there, demand for buying, and they try to take like a contra trade against whatever the market is doing. And even if there is a slight pullback from the down move, the crash in the IV that you'll see will be enough to give you like a 2.3 point profit, and you take that and you get out. So that's one approach. Just wanted to point that out. It's also why I'm not, even when this expands, even if this were to expand to 20 and this goes to 11, then I'm not going to be too quickly doing any adjustment to this, or I had really bad risk reward moving down my calls to 15,858. At that point, if this really starts to hurt, that we take the day's low out, then I will be squaring this off and selling the 15,650 put. So risking off on the put side rather than taking additional risk on the call side. We'll keep you posted. Time is almost 10 o'clock. Another thing that's something worth mentioning, like another small trick, is like keep an idea of what has been the pricing range of this put option. For example, when the market opened and we immediately dipped, this 15,700 put was trading at something like what's it called, about 1920. All right, and this call option was trading at the open at about 1112. Now into the up move, down move, different price changes happened. Similarly, this 15,750 put option into the initial down move was trading at something like 34. So there are a lot of people who have bought the option at 34 and now are losing money. So you can think psychologically, okay, if the price 34 comes, then there are a lot of people who will be like, okay, I can get out at cost, and they might do that, or they might continue to hold. Or the people who sold it initially, they sold it at 34, so right now they're sitting in profit. But in case that starts to go away, then they might unwind that position, which might lead it to cascade much higher from 34. So this is what price action actually is. It's just like understanding the psychology of who bought what at what price and what is their potential action at a different price point. So all of that is kind of, I mean, these things will help you understand. Like you will find that you can use price action on anything, on literally anything, because at the end of the day, it is nothing but where are different people sitting and what are their possible actions at those points. And if their view plays out, how will they behave? If their view doesn't play out, how will they behave? So all of that is something worth noting. For now, though, I mean, it's 10 o'clock and we continue to hold at about slightly above 15,800. And as far as open interest is concerned, it will be the same thing. A lot of positions built up at 15,800. Of course, skip price of straddle pricing, like what is it trading at? This opened at just about 100, I think, and it's trading 3 points lower than that. Okay, we continue to take support at 15,800 and head higher from there. What my plan is more or less that if we break this swing high here, we break 15,850, then I will have no option but to take these calls, half of them, and move them to 15,950. Take risk off on the call side. My analogy right now is that it's a very high probability that we trade in this range of 15,800 to 15,900, and even if there is an up move, it will halt. It's not going to be too big. There has been aggressive shorting of the 15,800 put option, and if there is an unwinding of that, then there could be a lot of downside pain. But into the up move, obviously the puts have lost a lot of their value, and at this pricing I don't want to roll up my put to 15,750. So instead what I'll do is I will just be taking risk off at different points. So if this expands close to about 20, then I will square this off and I will sell the 15,950 call, just taking risk off on the call side rather than taking additional put side credit. Okay, so just so the analogy is clear, I'm letting this position bleed into the up move because I do not want to risk off on these calls yet. or take on additional put side trade. I have very strict criteria. It is that I need this swing to first be broken, and then I will risk off. I'll risk off half first, and I'll risk off the rest. Right now, what I am expecting is, with the kind of open interest built up at 15,800, we will not very easily see too much upside beyond 15,800. There are massive amount of put shots that have been added at 15,800, which in case we have a down move, have a high threat of getting unbound, leading to a quick gain in put side price, whereas call side, I don't see it spiraling out of control. I do not need to be in a rush just because I'm like, okay, my market is going to negative, because I need to be willing to put some points on the table in order to benefit. So into a call side, I expect, unless that swing is broken, I'm not going to be risking off. So that's the plan. We'll keep you posted. Time is 11:25. Also, a question I get very often is, when market is moving the other direction, why is it that the super OTM hedges on the losing side, what should be the losing side, actually gain or keep their value versus the one which is on the winning side? So we gapped down, made an up move, but the calls have lost value and the puts have actually not lost any value. Why is that? It's because when you're seeing aggressive shorting of puts, which is what is happening today, people will buy. There'll be a huge demand for OTM puts, to buy them as a hedge, either for margin benefit or just to hedge their positions in general. So whatever is super OTM will actually not lose any value, at least until the long puts are. So now if you see a big cascade in the market, right, you'll see an increase. Like, let's say on the downside, you'll see an increase on this side and a relative decrease on this side, because they're so OTM that they're not even being considered part of the trade. They're not being considered part of the game at this point. They're just there to provide protection and to provide margin benefit. That's why you will see a lot of the time it's a contra relationship between the actual price move and the super OTM options. Also, like, after a point, right, like, you can't expect, considering tomorrow's expiry, you can't expect super OTM put options especially to be trading at, like, for example, this is how many points out of the money? It's about 400 points out of the money. You can't expect it to be trading at something like 1 rupee or 50 paisa, because in case there is some big event, I mean, there's an event today also that's taking place, which is the cabinet meeting, but in case something happens and if there's a big cascade, so why will people want to sell put options for that price and hold it overnight? So, okay, more or less nothing has changed since the last update. We had this dip, and once again, basically holding below 15,850, so I'm not doing anything. There was in expansion and IVs of both sides for a while, but something that's really concerning to me now is the 15,800 put is now the maximum open interest, with an average traded price of, let's say, up just slightly above 40. Now, in case there is some kind of a down move, then it can also very easily get unwound. That is a cause for concern. We continue to sort of head higher slowly, and these calls continue to expand. Puts really can't lose that much more at this point. I'm going to still wait though. My criteria, I will wait for 15,850 to be taken out, held, and then I will roll up the calls. In a relatively low IV environment, it should be all right. Even if there is some short covering triggered, it won't be that bad, because shorts have kept their distance. You see, maximum short open interest is actually 16,000, so not anywhere close to where we are currently on the spot. So these calls expanding should not be that big of a problem or a concern at this point. Okay, there is some data that is changing, so I'm going to partly risk off on the calls, and I'll then go over what it is that has changed. It was for about 40% of the quantity. Okay, basically what is happening now is we are making this higher low pattern consistently, and Bank Nifty as well, and Reliance has taken a bounce from 2100. What that does now is it stands to say that we will now take 15,850 out, so there is a possibility for that to happen, and I don't want all my calls to be at 15,900. So I've taken about 40% off. We clearly take out 15,850, then I will remove the rest of them in a staggered manner. I'm just doing this because there is enough premium on my calls that even if 60% are at 15,900, my delta will continue to remain negative, and I will benefit from being either sideways or heading lower from here. Yeah. Also, I mean, this makes me really uncomfortable. The fact that people have so aggressively shorted the 15800 put, because the same rate at which this has been shorted can be unbound also. So there is clearly an unwinding of the 15800 call and 15850 call slightly. That puts these at threats, at a threat. So it's taken 40% of the quantity off. We'll keep you posted. Time is 12:30, about halfway done. Okay, so another change made. We made a down move, and then we took once again support on the same trend line. So we are now basically, what I'm doing is I have taken in more put side credit, and I've moved back down whatever calls I had initially rolled away. I'm not expecting much upside anyway, and these puts into the down move, they spiked a little bit, so I got a good price around 19 on them, so I decided to take that. From here, I basically have a 3-point trailing stop loss. If I lose 3 points, I just exit. I'm not going to bother doing any more adjustments in the second half. It's just going to be this is the trade. Currently the strangle has a value of 34 roughly, and yeah, if it starts expanding to about 37, 38, I will just exit at that point rather than doing any other management from here. The time is 1:52, and now there is a strong up move coming from a conjunction of everything moving at once, and more or less I moved up my puts when the calls lost value in order to benefit from a bounce. Now, what this has shown is into the down move, we did see some put unwinding, but again, we are forming that higher low formation, and we continue to move higher now. So what's that doing to the trade? These calls are back up in price, and yeah, so same analogy. Maybe this time we take 15850 out, and if that is happening, I'll take these calls and roll them up to 15950 again. So it will be the same process once again. Today, I think because of the event later, we're seeing slightly abnormal behavior of options pricing, where into the down moves, the calls are really not giving up that much, and into the up moves, the puts are really not giving up that much. And in fact, as strangle, it's very difficult to really get too much of a fall off in price. Even though the range is so tight because of how risk is priced, it's being relatively difficult to benefit unless you really like selling calls into an up move and then waiting for a down move and selling puts and taking additional credit in accordance to that. Regardless, we continue to move up, and now we are potentially finally going to make that break. But too early to do anything. I'm not going to be in a rush to move the calls away. I'll wait for us to hold above 15850 or have like an immediate 20-point move from there before doing anything. Yeah, I think because of the event, we're not seeing too much of a fall off. We'll keep you posted. Okay, we're holding at 15850 more or less, and yeah, I'm not seeing where the rest of the strength will come from. Initially, the burst of short covering, these calls got bought back, pushed it about 21, 22, and now that has cooled off, they're really not expanding much. So what I've done is on my covered call position, which is the future long, monthly call short, and weekly call short, I booked the position, which is the weekly call short. I had sold it for 20, I bought it for 20. So nothing there, nothing done on the weekly call. And then I have sold next week 16,000 call for about 41.58. So this is the only change. What is happening now due to the nature of behavior of options? What in a down move, the put side heavy spiking and calls are not losing much, and in an up move, it's the same thing. So really, like, despite just holding range for such a long time, market does not think that the risk of the spread has come down in any way, so continues to be high. What my issue is that actually, if you see what I've mainly lost to today, in fact my entire loss comes from the hedging. So my super OTM hedges, obviously with tomorrow being the expiry, have given up both put together a little more than 1.5 point. So I'm down 1.5 point. Only that's like 85,000 bucks just from the hedges. So since the near the money options are really not giving up any value as such, or being very stingy in giving up value because of whatever risk might be there overnight, it is a tricky situation. But anyway, I have my stop loss, so I will just continue to hold this trade as long as it makes sense. We'll keep you posted. This trade would stop making sense if we make like a 15-20 point above 15,850, which I don't see how it will happen. It's not unless like Bank Nifty makes a big break. That doesn't seem likely at this point. We'll keep you posted. Okay, I have no shame in admitting I got played a little bit. Into the up move, I was forced to risk manage my calls because the calls really started to explode and it looked like potential short covering at that point. And I had to move up my puts, right, to 15,800. And then once again, massive red candle after that. These puts went down till about 22, and I entered them at about 22. They went up till about 29, and then I had to roll them back down. So in mitigating the upside risk, took additional downside risk, and as the downside risk played out, whatever benefit I should have had from that shakeout, completely out the door. Regardless, there's 30 minutes to go, and by doing what I did when I did, I ensured that my market basically stayed the same the entire time. But yeah, 30 minutes to go, and from here I would think a 2-point stop loss is the maximum that I would be willing to give up. So it's a 2-point stop loss or about 30 minutes of potential decay. Okay, I've just exited the position because some weird stuff happening last minute. I think today was just one of those days where I got played, and it would have been fine if not this last moment short covering that has come in, which yeah, it was a tricky day. I don't know. I did make a few uh, mistakes. I mean, right at the beginning of the day, that was, yeah, there we go, done. This last moment thing that happened here was unanticipated. So initially tried to respond and this up move got burnt a little bit there, and then the reversal got burnt there, and then this whatever, and short covering there. So I guess it's just one of those days where the market got the better of you, and yeah, best to just sit it out. I think, I mean, on my sizing, I lost about 1.5 points, and majority of what I lost is basically what I've lost is my hedge. You can see this has lost me 55, and it lost me 33. So I basically lost what I paid for hedging. Apart from that, trade was free. It'll be interesting. Let's see what happens now. Some major short covering seems to have triggered now, and we are at the day's high, racing away. Great. I hope you had a good trading day. It would have been tricky today for sure, but yeah, I hope you had a good trading day, and I will catch you tomorrow for the expiry. Take care.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab. So do not forget to check that from time to time.